Gold has fascinated investors for centuries. It has been used as money, a store of wealth, and a safe haven during periods of uncertainty. Even today, when markets become volatile or investors worry about inflation, interest rates, or geopolitical tensions, gold is often one of the first assets to enter the conversation. But that raises a very important question. When has history suggested gold has offered the most attractive opportunities for investors? Today we'll answer that question by combining a few perspectives. First, we'll look at the long-term investment case for gold. Second, we'll examine its historical seasonal behavior. And finally, we'll explore what that might mean for investors while remembering that seasonality is only one piece of the investment puzzle. Now, why gold still matters? Unlike most assets, gold doesn't generate earnings or pay dividends. Instead, investors typically own it for different reasons. Some will see it as a hedge against inflation. Others view it as protection during periods of economic or geopolitical uncertainty. And many institutions simply use gold as a portfolio diversifier because it has historically behaved differently from equities and bonds. That explains why, despite the growth of technology stocks and digital assets, gold remains a very important part of many long-term investment portfolios. Now, one of the advantages of Seasonax is that it allows us to move beyond opinions and examine historical tendencies. And this chart shows gold's seasonal behavior over multiple years. In fact, let's look at it over 25 years. And you can see that seasonally, rather than moving in a straight line, gold has historically experienced periods of stronger momentum and periods of consolidation. Now, you can see the start of the year tends to be very strong for gold, 72% winning trade percentage. And coming into the end of the year, you can see that's a very strong period. So you see from the middle of December through to late Feb, there's a strong period for gold. Then you look from April to July, the strength is a lot less. In fact, it's a negative average return over the last 25 years from April through to June. However, that seasonal tendency picks up quite nicely from the end of July into the middle of September. You can see once again a strong seasonal period in time for the Indian wedding season, and Christmas and the Chinese Lunar New Year tends to be reasons why gold gets a boost at those particular periods. Now, gold is more than an inflation hedge, right? Gold's often described as an inflation hedge, but in reality it's more nuanced. Gold can respond to changes in interest rate expectations, movement in the US dollar, central banks buying gold, geopolitical uncertainty, investor sentiment, and sometimes those different factors, interact with each other and can negate each other or amplify each other. In other words, several macroeconomic forces often influence gold at the same time, right? That's why it's important to consider both the broader economic backdrop and historical market behavior rather than just relying on a single narrative. If we take a look at gold now, let's compare it to gold miners. Now, gold mining companies, these businesses can sometimes amplify moves in gold prices because their profitability is directly linked to the value of the metal they produce. And if we look here over the last 25 years, we can see there's a very close correlation that gold miners tend to do very well at the start of the year. You can see that gold miners have an average return of 4%. Gold has an average return of 3.95% over the last 25 years. We also can see this little period from the middle of March through to the middle of April. Also strong period, particularly strong for gold miners. And if we look at that July to September period, strong for gold, 3.61% average return, 1.05% return for gold miners. But yet gold miners at the end of September into end of November tends to be a weak period for gold miners, and even though it's a positive period for gold. Now, while seasonality provides useful historical context, long-term investors should also consider the broader investment horizon and environment. Questions worth asking include, are real interest rates rising or falling? What's happening with inflation? How are central banks positioning themselves? Are they buying lots of gold or are they selling gold reserves? Is geopolitical uncertainty increasing? And is gold responding to that geopolitical, or is it looking through it? Is the US dollar strengthening or weakening? Now, seasonality works best when viewed alongside these broader macroeconomic factors rather than in isolation. So remember, it's not as straightforward as, if the dollar is strong, then gold is weak. So you can see here in 2024, with gold being priced in dollars, typically when you see the dollar moving one way, gold moves the other way. But you see, that's not always the case. So in March 2024, there was so much central bank buying from governments that the dollar was rising. And even though the dollar was rising, gold was rising. Typically, when you see the dollar falling, that supports gold. When you can see here, dollar falling from this period, gold rising. And at the moment, you can see that the dollar is rising and gold's rising with it as well. So it's not as straightforward as, gold must respond when one particular asset is doing one thing. It needs to be part of the wider picture. Similarly, here you can see we've got real interest rates here and the dollar overlaid. And usually when you have the real interest rates rising, the dollar rising, that weighs on gold. So these are the kind of factors that investors need to be looking at when they're considering investing in gold. The key lesson here isn't that gold always rises during one particular period of the year. Instead, history suggests that gold has tended to move through recurring seasonal phases with periods of relatively stronger and weaker performance. And understanding these historical tendencies can help investors add another layer of analysis when considering when and if to build, reduce, or review their gold exposure. Gold has survived inflation, deflation, financial crises, wars, and major shifts in the global economy. And its role in portfolios continues to be viewed by many investors as a strategic asset rather than simply another commodity. Now, seasonality won't tell us what gold will do next, but by combining, long-term historical tendencies with macroeconomic analysis, investors can make more informed decisions about one of the world's most closely watched assets. As always, while nobody can predict the future, seasonality offers another valuable perspective when analyzing financial markets. Remember, don't just trade it, Seasonax it.